Boy, oh boy, Marco from JP Morgan is very unhappy, but we're not going to start with him. We're going to start with what else is being said, and we'll end up with JPM's commentary on why this stock market correction that may now be starting might continue even after this earnings week. Now, that's even more bearish than what I said. Just a couple days ago, we made a very detailed video and said, look, this week is important. We have a lot of earnings this week that are going to give us a lot of insights into the consumer, from telecoms to artificial intelligence to advertising like the Rokus and Metas, right? The Microsofts. We've got huge earnings this week, the autos, Tesla and otherwise. And so I thought this week would be a catalyst for how is 72% of our economy? Are the consumers finally rolling over? Are they finally saying, yes, the charge-off, the massive doubling of charge-offs that we've seen at banks is finally starting to take a toll and is finally stopping the ridiculous greed and ludicrous euphoric spending that we're seeing? Will this week finally tell us that? Well, according to Marco, it doesn't matter what happens this week. Things are going to keep getting worse, not better. So before we hit him, because he's obviously pretty dang bearish, let's try to position ourselves a little bit. So here is the market ears description of where we sit with flows, equity inflows. And as you can see, we've clearly gone from a level of extreme bullishness on inflows back post-COVID. Obviously, you could see these spikes here, and you could see them again right here. But we've gone from these levels that are maybe not all the way at the top of extreme bull, but they've certainly topped out there towards the beginning of 2024, which makes sense. The market going up the way it has made sense for a while. And I'll tell you why. There's this reason. It is that we went into this period right here expecting 7 rate cuts this year. That has now been reduced to a market estimate of just 1.6. And the fact that the market has only moved from this level to here in terms of its actual bullish versus bearish positioning does suggest maybe there's a bit more to go. But do only 1.6 rate cuts take us all the way to extreme bear? Probably not. We'd probably have to see more things break to get to that sort of level, though it is possible. Because at the end of last year, between about July 19th and October 31st, we had a pretty bearish session. Markets were down substantially. We had a correction in the Qs, and many stocks peaked out in July to bottom out on Halloween. And what's fascinating about that is we can actually compare the timeline of the greed and fear index. Now, just Friday, we were at a 31 on fear. We're at 38 now, so we've recovered a little bit. This makes sense. You get a bounce today, the day after extreme bearishness. Well, the highest level of fear we've seen in a while. But take a look at the timeline. You can see we've gone down to this level of fear at about a 32. But we've seen this before where we come down and bounce, and it's right here. We come down into fear, bounce back up to neutral or maybe even greed, only to truly sell off a few weeks later into extreme fear. Now, this is fascinating because it does suggest we might end up having to push to extreme fear before we could truly mark a bottom on whatever the heck is happening in markets right now. And so this is interesting because it brings up Marco's argument on why we might actually continue to see a sell-off. And so that argument is right here. Another reason keeping us with a defensive stance is investor positioning. As we highlighted in our sister publication, Flows and Liquidity, the current market narrative and patterns are increasingly resembling those of last summer. That's not good, as inflation surprises to the upside and the Fed or other central bank rate cuts are priced out. Now, I don't actually think we're going to see other rate cuts priced out by other markets. It's mostly the US. But it's worth remembering that if US rates stay higher and everybody else reduces their rates, that makes the dollar more desirable because people want to buy our bonds, which increases demand for the dollar, so dollar goes up. That's actually bad for earnings. I think people forget that currency and a strong dollar matters to earnings. Companies that are selling 25 to 50% of their goods and services outside of the United States, they get hit by currency adjustments, and those can be painful in periods of a strong dollar. Of course, at the same time, we also have this comment here from Marco, which suggests investors are starting to look at reducing overweights or adding hedges in risk markets such as equities and credit. Now that's interesting because I thought, well, the greed and fear index actually lets us know how many people are starting to buy puts. So I went over here and looked, okay, market momentum's neutral. Okay, so it's not a momentum problem. Okay, stock price strength has gone fear. Okay, that's fine. We've done that before. We did that in January. Oh, okay, stock price breadth. Okay, whatever. So the difference between the ups and the downs. Okay, fear, that's not a big deal. Ooh, what do we have here? Interesting. We haven't actually gotten this close to into the 90s even. I would say, I guess we were in the low 90s over here, but we haven't gotten past a 0.95 since over here when we had our correction, which was again between that July. You can see in July, people start realizing, oh no, there's your bottom right there, July 19th. What did I say? There's your bottom. All of a sudden, oh, we need to start picking up the hedges, pick up the hedges, pick up the hedges. We run up here to about that's about where we are now, August 16th. And look at that, you actually had to become positive for the market correction to stop. You had to have people buying more puts than calls for the market correction to finally get to a phase of ending. And we have not hit that yet. If anything, you could argue that we sort of got rejected over here at the one. So we might be setting up for some more of those hedges, especially since those have started being really profitable. A lot of people in the Stocks and Psych group, they know this. They've been buying ARM puts, and at least last week going into Friday, we're like, okay, that's a good move down, maybe take some profits. People were doing really well on those. Now, what we want to talk about, though, is when does this end? What else is Marco seeing, and what are some of the other investors seeing? Well, Marco thinks that ultimately we're going to see Fed revisions and some Fed hawkishness. Now, I don't think that the Federal Reserve is actually going to raise interest rates again. I think the ceiling is in for rates unless we get some really bad reports. But I gotta say, folks have forgotten that the Federal Reserve actually matters. It's not just earnings, it's the Fed. Now I'm going to explain that right after I mention that you should come visit me in person at the House Hack Investor Roadshow. We are starting this event tomorrow, and it ends on May 1st. We're going to 23 different cities: Toronto, Miami, New York, Nashville's in there, Vegas. If you're wanting to go because you're an accredited investor and you want some exposure to an amazing real estate startup, my take, obviously, read the PPM. This is not a solicitation. It's linked right there, househack.com/2024. Then consider coming in person to these events. They'll be short, only going to be maybe me talking for about 15 minutes. Then we do maybe 30, 40 minutes of some Q&A, some pictures, and it's going to be time to go. So we're going to keep them nice, structured, and straightforward, super casual. We'll just sort of hang out at the airport together. You can check out all the locations and the information. But anyway, check that out at househack.com. So now let's focus on the Fed. When is the next Fed day? When's the next time Jay is going to come give us a good old rug and tuggins? It's May 1st. May 1st is also the deadline to invest in Househack, by the way. But anyway, May 1st, we are going to get a Powell that has literally gone from the last two meetings, January and March. We had a Powell that said, the recent data might just be a bump in the road. We think it's going to be lumpy and bumpy to get inflation down. We went from that kind of JPOW to last week getting a JPOW that said, we haven't gotten any more confidence from the latest inflation reports. Well, that's not great. If the last three inflation reports were not confidence-inducing in any direction, then that actually means even if we get a good report or two good reports, we're going to get a Fed that might say, one report doesn't make a trend. Two reports don't make a trend. What if they come in even worse? Tom Lee, one of our favorite market bulls, the person who's always a market bull, I feel like it's redundant, suggests, inflation's going to surprise to the downside. Great, but what if it surprises to the upside? What if we truly are visiting the potential of a second wave? Now, that's not my base case. I think we go through a bit of a correction here, and as long as we can avoid a joblessness recession, maybe we could stick the soft landing. But boy, we better start getting some good data coming in soon, because otherwise things could get poopy doopy very, very quickly. Especially since you're starting to get Wall Street waking up to that realization. Here's SocGen. SocGen economists no longer expect Fed rate cuts this year, and they see a no landing scenario. Now, they do think they're not expecting a wholesale risk off across assets. In other words, everybody sort of dumping their risk assets. They don't actually expect a wholesale sell-off. But then again, I try to read multiple different perspectives to make sure that I'm not just relying on one. For example, another perspective that I was looking into today was the Cadence Design earnings call, just to see, hey, what are we starting to get with some of the AI earnings? And let's just say their guidance wasn't as optimistic as people expected. They were asked about backlog, which came in less. Their Q2 numbers came in lower than expected. And when they were asked about the summer and what people should expect for forecasts for Q3 and 4, Cadence Designs sort of suggested, we'll let you know when we figure it out. So you're starting to see maybe a little bit of that toppiness and some of that earnings growth that you might expect from some of the AI companies. So it does make sense that there could be some rich valuations, which is very much in line with what Marco suggests over at JPM. Now, it is a concern, and I really hope this is not the case, but there is a real concern that maybe we're repeating the same mistake of the 70s. This is TS Lombard. This would be very bearish. And obviously here they've got the 2020s in red and the 70s in black. And they're suggesting, hey, the Fed might be going down the same exact path that led to the problem in the 70s, where you started cutting, inflation reanimated, and then you had to get Paul Volcker. That would be basically, this time is not different. We get the same as the 70s. Now, that's not my base case. I don't think that's going to happen. I pray that doesn't happen, because it's going to drive us into recession and a lot of joblessness. I don't want to see that, because recessions are very painful for everyone. I don't like when people lose jobs. Bad. Okay. Now, obviously, recessions to some extent are, from a macro point of view, healthy, right? There is a clearing that happens when you have a recession. Bad businesses that shouldn't be alive, zombie businesses, go bankrupt and they leave. This is very normal. It's a good, healthy clearing process, and it allows companies to lay off people that aren't as functional or practical to the business, or maybe as productive as people assume that they should be. And the companies are able to start over with less people, or start fresh with fewer people and try to build from there. Maybe that's exactly what Tesla's doing right now. But the real concern here is the market right now convinced that J-Powell's not going to talk dirty to us on May 1st? And I kind of think the market is mostly tenuous about earnings right now, which I'm not that optimistic on. I'm probably, if I had to pick between a scale of 1 to 10 on optimism for earnings, it'd be like a 3.5. So I'm definitely on the more sort of like, I think we're going to miss side. Or we'll beat, but we won't beat as much as Wall Street is actually expecting. And so we'll see sell-offs, we'll see profit taking, and then we'll get that correction we're looking for. That correction could really be accelerated by a positive J-Pow. As in, like, I should say a hawkish J-Pow, right? So now we should take the other side of this case as well. What if we have really good earnings? What if everything starts going back to the moon because we have really good earnings? How can we have a very bearish setup? Well, we got to get a dovish J-Pow. A J-Pow who says, hey, we still plan to cut this year. He might say that. He's said that before. He could say it this year or this meeting. He probably will, actually. Hey, our base case is still to cut this year, but if the data keeps coming in like this, maybe we won't. But what if you get a Powell who says, hey, even with the latest data, it's good enough for us to cut? Well, that would be bullish. And then you get bullish earnings. Maybe the fear was right for a short window of time. We had our little correction, nominal correction, and we're back to the races. That's possible, but it's really going to rely on earnings beating well past expectations, a more dovish Powell, and getting softer CPI reports. I think wishing for all three of those with prices, that is stock valuations where they are now, is a recipe for disaster. That's my take. I just hope that that sort of recipe for disaster doesn't create a stock market sell-off that drives us into recession. Now, some people have asked me about this. They're like, Kevin, how can a stock market sell-off drive us into recession? It's simple. As the stock market sells off, earnings need to do whatever, or companies need to do whatever they can do to beat on earnings again. And so they'll cut, lay off, and that starts the cycle. Anyway, these are some thoughts for tonight. Tesla earnings tomorrow, big day, we'll be covering them. Thank you so much for being here, and we'll see you tomorrow morning for the Market Open live stream. Thanks so much. Goodbye. Those, by the way, are every morning at 5:25 a.m., and they're on the Meet Kevin Market Live channel. So check that channel.
Advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.